This is something that, of course, JWB would be doing for you and preparing in advance for your calls. So, what we're looking at first is this is the portfolio generator that JWB does for our clients during our normal client onboarding process. So, if you're a new client, we would have a couple of phone conversations with you to fully understand your goals and your resources. And our calls would find ourselves here after we made sure that we built a strong relationship. As soon as we're ready, we're going to get to property selection. And so today we're fast forwarding right to property selection, and we're going to assume a few things. We're going to assume that your budget for this investment is $85,000. We're going to make a couple of other assumptions as we do this, just to see exactly how easy it is for us. Okay.
Assuming 85,000, you're looking to buy one house, and now we're looking at basically the available inventory that's out there for for JWB for somebody that's doing this, right?
Yeah, exactly. And this is something that I think many people really ask for. They want to see all of the inventory that's available. And we're really excited to be able to show that to you so that you can be included in the process of how JWB makes a property recommendation for you or and puts an entire portfolio together for you. It's not like, hey, listen, we're just going to show you the one or three or five properties that we think are right for you. That leaves a question in your head. Well, what about the other five? What about the other eight? Why didn't you choose those? So through this process, which every client gets to be a part of, you get to see this. You get to be a part. It's interactive, and you get to make the decisions really with us without us doing it exactly for you.
Got it. So do you see, I know that this has kind of like three buckets of numbers, right? It's got like or information, but it's essentially got the typical property information. It's got today numbers, right? Like purchase prices and property taxes and insurance that should all be baked into the equation. And then it's got tomorrow numbers, right? How this thing will perform over time. Things like maintenance rate and vacancy rate and expected rent price appreciation. All these things that your property managers should have these proprietary benchmarks based on what they've been able to perform on, right?
Well said. This is more about showing you how this recommended portfolio is substantiated, how it's built. These are all the numbers. We don't have to spend a lot of time looking through the numbers. But what we want to do is then click on that recommended portfolio tab. And there we go. So now what we're going to is the kind of the final resting place for what the property recommendations are going to be when we get there. But let me explain a little bit about how this page is built so everybody gets comfortable with it. And then we'll start wheeling and dealing and putting this together as a community. We're going to do this together today. So in the top left there, you'll see your client information. Of course, this is our sample client portfolio today, the investment horizon and the time that the client, through their goals, has dictated that they'd like to hold on to the property is 10 years. And the client came to us, let's say that you came to us and said, I have $85,000 that I'd like to invest. The section right below that is the real estate portfolio investment summary. I love this section because what it does is it helps us just think of what we're ultimately hoping to accomplish. You are looking to bring this asset, bring a certain amount of money to this asset class, and it's our job to grow that money for you so that you can look in 10 years and say, wow, my investment grew to a very substantial amount. It helps to remove some of the emotion of what we are doing here, which I think is important to make sound decisions. At the end of the day, this is an investment for you. And just because it's a home and that we all live in a home, it doesn't mean that we have to think about this as us living in the homes that we are going to invest in. And that's important because you are not your resident. Your job is to create a great living situation that somebody else can enjoy, and you need to remove the emotion. So for this section right here, we're going to be able to see when that client brings that roughly $85,000 to this portfolio, how much is it going to be worth in 10 years? And obviously right now it's filled with all the properties, so the numbers don't make sense, but that's what you'll see when we get there. If we go to the right a little bit here to that section right there, Vanna, you are doing incredible. It's important to understand, now that we understand how much our money is going to grow, how does it grow? And that comes down to the 5 profit centers that this beautiful asset class has. And we need to understand which ones are driving most of the growth. And we need to make sure that all of them are positive. And so that's what this section will show us. It shows us our net rental income, our tax savings, our principal pay down, our home price appreciation, and also gives us an overview of the inflation hedging and inflation profiting section, which is the 5th profit center. We even include the acquisition and liquidation costs. Many times investors forget to include this when they're running their analysis, but we include those numbers because that's how you That's how you analyze growth the right way. And then ultimately what it does is it kicks out a nice pie chart. So you'll be able to see how much of your growth is determined by the different profit centers. And Pablo, what's this principle called?
The Pac-Man principle, the idea that every time you do this, I mean, right now we have like all the homes in the portfolio loaded in, and even with all of them loaded in, you see that the number one, place that you build wealth in this pie chart is home price appreciation. So when you lay it out in a pie chart, the Pac-Man is home price appreciation. Everything else is the mouth of the Pac-Man.
Well done. So that's at a high level. Now let's get into the meat and potatoes here, right? Us putting together this portfolio of the month.
So now we're looking at these properties. We got what is it, 15 of these in here? Something like
That's
that?
right.
15 properties in here. We see in one column the highest ROIs. We see in another column the estimated total investments. And then what was that third piece you see? Fit
Well,
within
we need to
budget.
make sure it fits within the budget.
Yeah.
Yeah.
Why wouldn't we start with the budget first?
That's a great question. So the first thing we're looking at, of course, is the rate of return. The thing about the budget, of course, we need to fit it within the budget. But the budget can be, or the amount that you put into a property can be malleable. We might be able to put 30% down for one property, or we might be able to put 25% down or 20%. And so really the reason we start with return is that's the most important thing, but it also gives us the opportunity to later on think of some properties that might be a little bit over the budget, but maybe adjust the percentage down and maybe they become the winner. So if we went just strictly budget first, we might miss another opportunity if we did it that way.
Got it. So let's pick some homes, shall we?
Let's do it. Okay, so now we know we're going to focus on returns first. We're going to make sure that there's enough cash flow, positive cash flow, and then we're going to, of course, keep the budget in mind there. So let us start with. Do we have 30% down on all the properties on the first tab, Paulo? I just wanted to make sure.
We have 30% down, GC.
Okay, perfect. So now let's kick it back over to the right there, where we're looking at the net rental income per property. So this section to the right here is really important because what it does is it allows us to look per property and make sure that each of these hits the criteria that we are looking for. So the reason I asked about 30% down is because that's where we typically start when building a portfolio. The relationship between how much you put down and cash flow is really interesting. If we put more down, then we are going to have higher cash flows. If we put less down for that same property, we're going to have less cash flows. So it's interesting when people say, hey, are your properties cash flow positive? I mean, the easiest thing to do is to create a cash flow positive situation. It's just, it might be a factor of how much we need to put down. So here we're starting at 30% because properties are typically cash flow positive at 30%. And now we're going to say, okay, well, how many of those properties are cash flow positive? Are there any that are cash flow negative? Which ones can we eliminate? And so there you go. That just highlighting that column right there, that's the net rental income column right there. Yeah, right there. Exactly. So what do we see? All of those are positive, right?
All of them are positive.
Okay. So now as a financial engineer, which is what your JWB teammate is going to be performing for you, financial engineering, when we see that every property is positive like that, what we are going to do next is say, listen, let's test this out and put less down and see how many properties are still cash flow positive. Because when you put less down, your cash flow goes down, but your rate of return goes up. And of course, it's less money out of pocket. So we all like that. So now, Pablo, let's go back to the other tab, the portfolio generator tab.
Okay.
Not that one. Go back. Yeah,
yep,
go back to the tab at the bottom.
All right. Yep.
You're doing great, Vanna. You're doing great.
25?
Yeah, change that to 25% for all of them. And now go back to that portfolio recommended tab. There we go. So now we've seen some of these same properties that were cash flow positive are now cash flow negative, right? This is the relationship between down payment, cash flow, and of course, return on investment. I don't know if anybody was paying attention, but what we also noticed is that our return on investment, if you want to highlight that column there, Vanna, our return, well done. Our return on investment actually went up for every single property, which is the relationship there. So I did a little planning ahead of time, as you guys would expect, and we have 5 properties that are still cash flow positive at 25% down. I should also clarify that this net rental income column is looking at the 10-year horizon and understanding if it is cash flow positive or cash flow negative. Every property that JWB sells is cash flow positive in its first year. A part of that is our maintenance credit. A part of that is the maintenance credit, which is worth between $4,000 to $6,000 that every client gets. That in itself is delivered to you day one when you own it's actually delivered to you within your first month of ownership. So you get that in the first year. And so by default, every JWB property is cash flow positive in the first year. What we also want to make sure is that it's cash flow positive over 10 years. And that's what the column that you're seeing, net rental income right there, is specifying. Does that make sense, Pablo?
Yeah, it makes sense. It makes sense that at 30%, they're all cash flow positive over 10 years. And then like at 25%, it's less, right?
Exactly. And the returns are higher. So we're constantly going to be looking at how little can we put down and still be cash flow positive,
Mhm.
right? So there's 5 properties. So let's identify those properties. If you go back to the other tab and let's just rank them out one through 5. We've got the 2 Caroline's Courts.
Let me just delete all this real quick. So we got Caroline number 1, Caroline number 2. We
We've
got
got 8311 Dandy.
Dandy,
We've got Cocoa, and then we've
Cocoa,
got Fifth Avenue South.
and Fifth Avenue South.
All right, let's go back to the other tab. So now what we've been able to do is just focus on the one property, or excuse me, just the 5 properties. But out of this, we're going to find one property that's going to hit that criteria. And we're only looking at properties that are cash flow positive. And we know that we have 5 choices that are at 25% down. We know that these are going to have the highest returns as well. And what we can start to do is do a little bit of a elimination just based on budget at this point, right? The first one to eliminate is that property on Fifth Ave South. That is a property that's actually out near Jacksonville Beach. And so the market value of that home is much higher, which means the down payment is out of reach for us with our current budget. So we're going to eliminate that one in a second here. The other one to eliminate, and don't change the tab yet, but the other one we're going to eliminate is this one on Dandy Avenue. And the reason there is that the total initial investment is a little bit outside of our budget. It's about $91,000. And for this example, we have 85. So we're going to eliminate that one as well. So
Should
if
I
you
go
want to go
back and do
back,
that?
yep, you can go eliminate those 2, repopulate 1, 2, and 3, which would be the 2 Carolines and the Cocoa Avenue.
Okay.
All right. So now we have these 3 properties, and I just want you to notice how similar the 3 of these properties are in terms of return on investment, in terms of out of pocket, and in terms of cash flow. This isn't a coincidence. Everything you see with JWB is following the same model over and over and over again. We attempt to basically widgetize rental properties at the end of the day. And so you can see this here. The choices that you get to make are all very similar. And this is why clients who buy today are going to be, choose an individual property. But if you come back next week, you're going to see a different individual property that is very similar. And you can kind of see that here. The 2
Yeah, that's kind of
Carolines.
the genius of your model, GC, is the widgetization of all of this, right? Like the idea that you have created essentially you've had to create like an assembly line of new construction and existing properties that you can build to that you can bring to market with a similar investment profile is the big unlock in people like me being able to plan my retirement around this. If not, the variability would be too high.
Exactly. Simple, repeatable. When
Yeah.
things are simple and repeatable, it makes it more enjoyable for me because I have to spend less of my brain activity trying to figure something out. I just know it works. And that's what we create for clients. That's how we've been able to do the same thing over and over and over again for just about 20 years.
Love it. So what's the pick here, man?
So you've got the 2 Carolines at 10.8% returns, the Cocoa property at 10.9% returns, and all 3 of them have positive cash flow, and all 3 of them are within the budget. So what we're going to choose here, it's kind of like, they're all winners, but we're going to choose one of them, and we're just going to stick to our same criteria. Cocoa has the highest return on investment, which is 10.9%. It's within the budget. It's at $85,000 roughly total out of pocket. And it has the most positive cash flow by a little bit over the other 2 Carolines. So 7636 Cocoa Avenue would be our recommendation. That would be the choice for you. And this is the one that we would choose for starting your first rental property in the portfolio with JWB.
Boom. So Cocoa is the winner.